The S&P 500 is at an all-time high. Gold broke out over 4,000. Silver's touching $49. Even Bitcoin is trading close to an all-time high. The dollar is trading strong. The only market that is not moving, or the only asset class not moving, are the bonds right now. The US 10-year pretty much moving sideways. What does that all mean? Are we in an everything bubble? Is that just the flood of liquidity that we've seen that was created over the last few years, creating a final melt-up? I've invited a fantastic guest to discuss. It's Ted Oakley. He's a managing partner over at Oxbow Advisors, and I'm really looking forward to getting his insights, because I also want to touch with him on discussing whether the cookie is already crumbling, meaning we've seen some bankruptcies on the auto loan side or on the auto industry side that could be an indicator. So I'm really curious to see and hear what he has to say about that. Before I switch over to my guest, hit that like and subscribe button. It helps us out tremendously, and we much appreciate that. Thank you so much for doing that. Now, Ted, it is great to welcome you back on the program. It's fantastic to see you again.
Good to see you, Kai.
Really looking forward to this, Ted. I really appreciate your insights. Maybe we'll start off with the markets. We have to make sense of what we're seeing right now. I just called it the everything rally. I can't shake that feeling. The question, though, is why is it happening? Like, why are people throwing money into the markets across all asset classes? What are you seeing?
Well, you know, Kai, our quarterly market letter is going to come out here in a day or two. And the title on it is Party Like It's 1999. Now, unlike a lot of people, I've been around a lot of these decades and so seen different kinds. But it really is a lot like 99. That's what we referred to in the letter. Because of this, in 1999, no matter what you did, the market went up the next day. And the news could be good, it could be bad, and everything went up with it. NASDAQ had a huge year that year up into all the way up into March of 2000. And it didn't make any difference. And what happens is when you get to these periods where you're going to probably have, what I call sort of a blow off market, but it's a period where things are going so well and nothing dents it, that people just keep staying the course and then adding to it, because there's nothing that makes you punch the go button more than making money. So if you made money today and somebody says you put more money in, we make more money tomorrow, it just keeps right on going until something changes. And that could be, 3-6 months into the future. I don't know. Could be tomorrow. But the point is that when you're in these kinds of markets, they just go up, and there's really not any rhyme or reason for it. There's not a lot of big changes between now and 6 months ago. Not really. So that's sort of how we see it.
Yeah, it's interesting because you picked 1999 and the market ran for another 2 years. And it was also a tech-driven market at the time as well. Like, what are some of the parallels that you're seeing besides, of course, the euphoria and people just
it sort of did 2 years. It really went from, if you take from January 1 of 99, it peaked. The market peak was March of 2000, the end of March, into that quarter. It fell off about 40%, came back in the fall, but never did make a new high. And what happens is that similar, you had certain companies then. If you look back then, the companies that were, real go-go companies, they were talking about fiber build out, everything you could think of. And they started with Cisco and go to WorldCom. And there were so many of that were in that group. And you could go public and put .com behind whatever the name was, and it didn't make any difference. In my office, I have a list of 300 companies that between 1998 and 2000 went under, and they all had .com on the last part of the name. It's very similar now. You add AI to the name. It doesn't make a difference whether you make any money or not. They're going to buy it, and then everybody feels compelled to jump on that. And a lot of people can't think for themselves. So if they tell you that AI is going to do this or that or the other, instead of thinking it out, they just jump on. And that's sort of where we are now. And the parallels really have to do with fiber build out and AI build out. All right. They're very, very similar. They overbuild, like we'll overbuild the data centers, we'll overbuild all that stuff. And then you look back and you're not getting a return on capital. And so it doesn't work. The prices go down 3 years from now.
I get it. Although I keep it trying to imagine pets.ai, what that looks like, quite honestly, like what an artificial animal looks like or an artificial pet. But that's beside the point. But you've been touching on something that's quite important, and it's the market is ignoring bad news. Bad news, and I mentioned in the intro, like either negative jobs numbers or bankruptcies, like in the auto sector. We've seen
Yeah.
First Brands or Tricolor sort of just going toward to chapter 11, and the market seems to be shrugging it off. Bit of a warning shot again was today. Jefferies announced that their funds are exposed to about 715 million in bad loans to those companies. What do you make of that? It's like I'm looking for cracks, of course. Is that one that I should be paying closer attention to?
Well, the problem about private credit all along is everybody, lauds private credit, but just think about it. If you're a company, I'm part of a bank. So if somebody comes to our bank and can borrow at prime at 7.25, and they're such a great company, why would they go out and buy it, borrow at 11.25 or 12 when they're that great a company? So you can tell me all day that the credits are really great, but obviously they're not. And there's a lot of leverage in that business. There's probably a lot more of that to come because you have all these different tranches. I mean, one of those groups you're talking about was, they had it rated AAA up until, a month ahead of time. And we don't ever, we wouldn't have gone that direction anyway. But if you look at private credit and private equity, both, they've got them leveraged. They're sort of a fake look in many, many ways. And, they've been able to ride the wave right now, but they pushed too much money into those two areas. So they bought a lot of marginal stuff. And when you buy a lot of marginal stuff, a lot of it's going to go bad. And now really coming home to roost. And I think that's where you are right now.
Yeah, for a while, my Instagram feed showed me reels about people buying cars with 120-month leases at 4% and $10,000 down. I had to laugh about that. But as you said, now the chickens are coming home to roost, because it does remind me of what we've seen, the housing crisis, but just more fragmented, it feels like, which is more difficult to track. Would you agree with that? Like, how do we track that?
Well, the auto market's like the rest of the economy. The people that have a lot of money, that have the stocks and all that, they've got a lot of money right now. They're doing great. They walk in and pay cash for a car. Or they'll buy big name. That's not a problem. And for them, it's that next tier down, really, the next 2 or 3 tiers where they're having to pay a note, they pay it by the month. And a lot of them are underwater. And, most of the people on Wall Street have no idea what it takes to operate in the real world of Main Street, and people have to work for a living and go week to week. I mean, I grew up poor, so I got that down. But they don't, okay? Because they've been in these Ivy League towers all their life, and they think they got it down, but they don't realize that there's 2 pieces to that, and one piece is deteriorating quickly. The other piece doesn't make any difference because they've got money and they spend it.
No, fair enough. It's the subprime auto loans is an interesting sector. I had a few guests on about 6 months ago that I'll need to bring back, because it feels like that's where the cracks are starting to appear. I'm not sure if it's a trend yet, but it's definitely a signal. Would you agree?
Oh, no question about it. But it had to be that way, because when you leverage up like that and you're leveraging up things that are not, that you don't have good quality. If you're going to leverage, you need to be able to leverage. Number one, don't leverage too much. And second, leverage things that have great, sustainable, very good cash flow. If you're going to use any kind of leverage, real estate, whatever. And they didn't have that. And that's the problem.
No, fair enough. Like, I'm just looking for cracks in the system,
Yeah,
maybe signals that markets are ignoring, of course, right? And as you said, like, the market doesn't really care about bad news right now until the chickens all come home to roost at the same time, right? And that'll be a challenge. Another signal, really, maybe I'm interpreting too much on the negative side here, is the government shutdown in the U.S. right now. We're at day 6 or 7. I lost track a little bit. I don't have an official tracker hanging behind me, but I think it is day 6, if I'm not mistaken. What are the ramifications or implications of the government shutdown? What are you seeing? Again, the market is shrugging it off. Even the dollar is rallying, which I didn't really expect seeing that. And rallying is a bit of a strong word, but it's it's doing okay given the environment we're in. What do you make of the shutdown there, Ted?
Well, I think people think they talk too much about it. I mean, I go way back. So, I was in the business all during the Reagan years. Reagan had 8 shutdowns. Okay. It never lasts because politically they don't have the wherewithal, the guts, I should say, to do it. And they won't have, and they never do, because once they get the voters, putting pressure on them, it never lasts. And so that's not a problem. It's going to close. You don't know which day or whatever. And to me, it's sort of a meaningless thing. There's a lot of talking goes on, but in the end, it'll be business as usual. I don't think there'll be a lot of changes. They'll come back together and maybe they change one thing or two things, and everybody claims to have a victory. It's just typical DC politics.
Yeah, it seems business as usual. Although I'm not hearing a lot of progress, to be honest. So I'm not sure if that's even an opportunity. And I mentioned to you maybe secretly pushing through a Doge 2.0 agenda here. Is that something you would maybe assume or look at, and maybe as a takeaway? I'm trying to figure this out, of course.
I understand what you're saying. I'm sure there could be a little bit of that. But if you told me they had the guts right now to keep the government closed for the next 2 months, I'd certainly take that bet and give odds. Because I don't think they'll ever make it.
No, that's it's very true. Like, I'm curious how this all ends, because just watching the news and being on X here, I don't see a lot of progress being made on either side of the aisle here. So I'm really curious how this all plays out and how much longer it will be. Do you know, top of your head, Ted, what the record is in terms of shutdown? What was the longest time the government was shut down?
I don't.
Okay.
I don't. I mean, there's a lot of them. I mean, there's been so many shutdowns, in the last 50 years that it becomes a big yawn after a while, because they act like it's a big deal, but they don't have the fortitude to do something tough. So you don't have to worry about that.
No, you're right. And the market seems to be shrugging it off as well. Just non-event. So surprising.
I think the market right now shrugs off everything. So you're at that stage, when you get to these stages of the market, they just go up, and that's where you have to start keeping your head on straight.
Bit of a bigger topic here, Ted, that we need to discuss as well. It's just the stance or the position of the Fed in all of this in general. They've cut 25 basis points here in September. Right now, we're not getting a lot of data, but I think the trend is pretty clear that we'll at least see another 25 basis point cut based on the employment data that we've been seeing. ADP report, for example, absolutely horrible. So I'm curious, what's the Fed's position? What do you think of the last rate cut? Was it too early? Was it too late? Was it the right time? And where do you see the Fed headed here?
Mm-hmm. Well, one thing for sure, they don't know what they're doing. I've watched the Fed my entire career. So, they're going to be late or not doing the right thing. And the problem with lowering rates right now is that we really shouldn't be lowering rates. I mean, you have 3% inflation. And you can say, well, I'm going to forego inflation for unemployment. But what they don't realize is the most detrimental thing you can do to an economy and the working class is to have inflation. So and they sound like they want to lower once or twice before year end. Let's say you do that, okay? But you're going to be reinflating again by the end of the first quarter and second quarter. They're going to have to come back and say, gosh, all this money is in the system. See, everybody keeps on speculating again. And we've got a Federal Reserve that's brain dead to what they should be doing. And right now they're folding politically. And it looks like they're going to fold politically because they're going to stack the deck. And it'll be like the 70s under Arthur Burns, where they keep trying to lower the rates to get things going, but it kicks the inflation rate back up. They got to come back and finally get so bad that somebody like Volcker came in and said, I'm going to fix it, but you're not going to like the way I do it.
So what you're saying, Ted, maybe I hope I'm not taking this wrong, but you're saying at focusing on employment data is probably the wrong way to look at this. Inflation is the much bigger problem that might be roaring back here.
I think it is, because inflation is a stealth tax. In other words, if you look at what affects the average family that just barely gets by, it's inflation. See, that's what they don't know on Wall Street. if my groceries are going up, my electricity is going up, a la data centers, and my car payments, everything's going up because we're having to charge more for everything, then I can't make it to the next month because I'm not getting that kind of raise, you see. And they forget about that. And that's what puts pressure. And that's what brings you into these periods where you throw your economy into a tailspin.
What should the Fed be doing, in your opinion? We all know they've been wrong and maybe late even, focusing on the wrong things here. What should they be doing? If you were Jerome Powell today or tomorrow, Ted, what would you do?
Well, I don't know that I would be right either, but what I would be doing right now is nothing. I don't think there's any reason. And in the long 30-year bond's telling you that. The 30-year bond hasn't changed much at all in 6 months. And it's basically saying it has a little bit, but not much. And I think those buyers are saying, hey, you know what? You people got it all wrong. You can lower the short-term rates and try to juice the economy and that sort of thing, but you're going to give it up on the inflation side. And so if I were the Fed, I would do nothing. I just go just like we are. And, that's not going to happen politically, because obviously you can see what's going to happen. They're going to stack the deck here with the people on the board, and they've already succumbed to it. So I don't think they're going to change.
No, it makes sense. Personally, I would have almost advocated for higher interest rates.
You could have. I may even be late for that too, because you got two things going on at the same time, and I don't know. I just think they'd have been better off not to raise them, not to lower them. I mean.
Yeah, no, because it's also the signal that it sends, and 25 basis points doesn't make a difference. Not really.
Mm-hmm. Well, don't tell me you're independent when all of a sudden you get this pressure from the White House and you lower the rates. So everybody knows
good
that.
point.
So I'm not a genius on that. Everybody knows that.
Yeah, no, exactly. And their forecast, employment-wise, is trending lower in 2 years. So why be worried about it if it's only temporary? Or was the nice term he said he used, transitory? Higher unemployment might only be transitory. I don't know. I'm just paraphrasing, right? But if we were to use that term, because that's what the summary of the economic projections told us. Okay, it's temporary. It's transitory. Higher unemployment. Why be reacting to it? Just doesn't make a whole lot of sense if coming from that perspective. Would you agree?
Yeah, I agree.
So let's talk about asset classes a little bit, because I remember, and I hope I'm not wrong here. I hope I'm not remembering the wrong, but you were advising, at least looking at bonds for a while, 4.5, 5 years. Hope I'm not wrong there, Ted. What is your stance on bonds right now?
Well, what we own at the time, what we own, when I say bonds, we have short maturities. So everything we have is less than 48 months. So now I'll tell you, we have a few corporate bonds that are 60 months. They're not now because we haven't bought anything like that recently, but our average maturity on the corporate bonds is probably, and we don't own that much of them, probably 12% of my portfolio, but that's probably now about 3.5. But on the treasuries, we're 2 years and less. So we're not in the long-term paper at all.
Okay. So no exposure on the long end there at all. You're still happy though with the yield that you're generating on the shorter-term treasuries?
Well, we are. They're going to go, and they'll probably go lower. And what I've told people is, look, you're just going to have to grin and bear it here for about the next 6 months, because if they keep on lowering rates, that rate's going to go down. However, we think within 9 months from now that inflation is going to be back running hard again, and then they're going to have to come back and take you right back up. So if you take the bait and go buy a 20 or 30-year bond or a bond fund, you're going to get caught again, just like you did back in 2022. And they keep sort of going back to the well, but I don't think in the next 10 years you should have anything in your portfolio that's more than 60 months max, even if you have that, because we're just not going to be in a period, I think, with inflation being a higher level, and it's not the time to really make a bet on long-term interest rates, because they're probably going to go up.
The 60/40 model or portfolio model is under attack, and it's changing. Morgan Stanley said, well, you should be looking at 60/20/20. Even Ray Dalio yesterday said in a Bloomberg interview, 15% allocation to gold makes sense. But let's start with the bond side here. Does it make sense to reduce your bond exposure from 40% to 20% and then allocate elsewhere?
It depends on what you're doing. I mean, we have 3 portfolios, and I'll give you an example. In the stock portfolio, if we can't find stocks that fit our criteria to buy, then we hold those in, 90-day and 180-day treasuries. And so we've got about 40% of that portfolio in treasuries right now. I'm not trying to time the market, but it shows you how expensive the stocks are right now. So to get a really good value, you have to be real picky about what you buy. And you can't continue buying this unprofitable stuff and all this crazy stuff they do. So that's how we use the treasury. We don't think about it as an allocation at all. If the prices were cheap tomorrow, even in our high income portfolio, which we have probably 50% treasuries, only because we don't have the things we want to own. And by the way, they've all done really well, believe it or not, because we had the right allocation. Well, we had the right stocks and income items we wanted to own. They've done well. And you can do well and have a fairly high allocation to treasuries. But if things got really, really cheap, we wouldn't have any allocation to treasury. We would be 5%. And it all has to do with prices and what the valuations are. So that's what I was saying is you have to be, we don't have that thing where you say, well, we're 60/40 or 60, whatever you say, 60/20/20. We buy them when they're cheap. And that's how we allocate.
That should be the only way to do it, to be honest. But back in the past, it was too easy just to allocate and just let it ride, to simplify, right?
Well, I think that's where people will get in trouble, though, the next 5 years. I think a lot of people in our industry, they've never been through any hard times. They've been used to just allocating, buy me 10, 12, 11, exchange traded funds, and I'll allocate amongst this, that, and the other. And then they just forget about it, charge you 1% and going down the road. But the problem is you're going to be in a changing atmosphere probably where commodities do better, debt does not do well. And you better be able to trade the markets to a degree, because there's times when you're going to need to have a lot of liquidity, much like the 70s and early 80s. And other times you'll be fully invested. But the people we have in the industry today are not programmed that way. They've been raised up to just buy a certain few things, and you'll be good 20 years later from now. And I think that'll be the trap right there.
This is always the long-term thinking. Like I remember people telling me, just buy the DAX or buy the Dow Jones or the NASDAQ. Just dollar cost average. Is dollar cost averaging dead as well because it's too long-term focused?
Well, I don't think you should dollar cost debt. No, not at all. I think you ought to keep your debt close in, because you've got to be able to define debt is your safety valve. Well, if you've got 25 and 30-year paper and it goes down 25 or 30%, it's not a safety valve anymore. It's a cost. Okay. And you're going to worry about that. You should have a bond portfolio, treasuries, or whatever you want to use. We use treasuries. That's short enough so that if anything goes wrong, that is very, very safe. And you can use that to your advantage to either buy things that are really cheap, sleep well at night, make sure you're okay. But you can't just throw in a bunch of things and say, I'm going to be better 20 years from now, because I could give you the statistics on it. Go back to 1900 and the markets go through numerous 20 and 30-year periods where they make zero money, nothing. We've forgotten about it now in the last 20 years in this country, but I'm telling you, it happens. And you have to be in a position where you can weather any storm that comes your way, sleep at night, and know you're not going to lose everything. The problem about most people is they put it in there and everything's fine, they make some money, and then they come along and they get a big setback, and emotionally they're not ready for it. So they sell out at the worst time.
People always sell at the bottom and never buy it, or buy at the top, sell at the bottoms, right?
They buy
That's why
buy at the top. I will tell you that. They're doing that right now.
Yeah, I think we need to discuss that, because there's one last asset class that I want to use the last 5 minutes on to discuss with you here as well, Ted, is gold, of course. Where are we in gold? Is gold part of the everything bubble that I've mentioned, or would you exclude that? Is that a separate asset class because it behaves differently? Curious what your thoughts are here on gold, Ted.
Well, Kai, it's a good question. I mean, we've owned gold and the miners for a long time, so it's nothing new to us. And we've got, obviously big profits in it. We haven't taken really much of it off, but here's a big question, and you'll never know exactly answer this, but are you in a second leg of a market that's going to go a lot higher? I'm talking about gold. As you go back and look at 1975 or 76 in gold, all the way up for the peak in January of 1980, it was a big move. I mean, it was a 6, 7, 8 fold move, and then it corrected big. If you take our low of, I don't know, 1,1600, whatever it was at the low, and you put on 4,000, that's not 6 times, okay? And I'm not saying we're going to 9,000 either, but it's hard to say whether that goes on. Now, you could get a correction, I think, anytime of 15% or something. And I know people would think it's over, I'm going to sell out, but probably more than likely, even if you got that, later on, over the next 5, 6, 7 years, you go to higher highs, and you'll probably be sorry that you sold it. But it wouldn't surprise me to get it. But either one wouldn't surprise me. It wouldn't surprise me to go on up from here, because obviously it turned real parabolic. And now you're starting to see the articles in the paper, on CNBC and Bloomberg, when they start talking about it. But I will tell you this, though. It's way underowned. If you go look at, for example, the GDX, which is the large gold miners, they've actually had money flowed out of the system in this year. In other words, they go up, but people take the money out. And as a percentage of assets, you look at even today where the gold miners are, they're nothing as a percentage of the market compared to any other group. So there's a lot of room to run there. I know they've had big moves, but I don't think you can always say, well, it's over now. I don't know if it's over or not. I don't think it is, but even if we got some selling, it wouldn't make us clear out. We would, I'm not saying we wouldn't take some profits maybe here or there, but generally, I think you have to look at gold over the next 3 to 5 years. There will come a point when it's too high. I mean, when gold corrects, it really corrects. So you have to, when its time is over, then you have to think about it. But you have to look at geopolitics today, and now it's going opposite direction. Most people would say when the dollar goes up, interest rates tick up a little bit, then gold goes down. But see, they're correlated. The dollar's going up and gold's going up. And so, it's got them confused. But I think it has to do with central governments, and they're just saying, hey, you know what? We're not buying the dollar. We'll buy some of it, but we're not going to hold the bonds. We're just going to buy the gold. That's
what the Swiss National Bank said just recently. We're buying euros. We're not buying the dollar. And the euro is now the most important reserve currency that the Swiss National Bank holds, not the US dollar anymore. So it's just small cracks in the system that we're seeing that are shifts happening. Absolutely. Yeah. And maybe one more thing, Ted, as well, like Q3 numbers are around the corner for the big miners or for the producers. And we continue to see margin expansion. So from the mining side, do you still see there's a lot of opportunity in the stock? You've been touching on it, but maybe just elaborate on that just a tad more.
Well, the industry has a group, so they know what the cost of production is. It's about $1,600 now an ounce. And so if you look at that relative to price today, then you have to factor that into these gold miners, and because they're super profitable. Now, if they sold at the same price to cash flow multiples today that they did in 2011, and I may be off on this some, but they're probably twice as high as they are right now. Because, they've gotten a big push. I know they've gone up, but they have not gotten the buying from the institutional people that you think. And if the price stays up here or goes higher, they're just going to make more money. Even if it fell off, if say gold fell back from 4,000 to 3,000, they're still making $1,400 an ounce. I mean, it's not like it's not a good business. So people have to keep that in mind. What's your cost of production? And that's where we are right now.
And that's just analyst consensus as well. So like the analysts haven't even priced in spot gold. That's
exactly
the point. So absolutely. Ted, what a wonderful conversation. I always love catching up with you. Fantastic insights. A bit of a rhetorical question because our audience should know the answer, but where can they find more of your work, Ted?
Well, the best place is just come to the website. It's oxbowadvisors.com. Because really, Kai, everything we do is there. We're very, very transparent. We don't have all the answers. We got a lot of questions, but we don't have all the answers. But you'll see everything we do there.
Fantastic. Ted, really appreciate you joining us again. Much appreciated. Thanks so much for your time. And everybody else, thank you so much for watching Soar Financially. As you can tell, I'm not in my original studio, but I do love that curtain behind me. It is sort of the Soar Financially colors here. I'm traveling, so I do appreciate your patience with my lighting and everything else. Not too pleased with it here. A bit too much orange today in my face. But I'm really curious, what do you think? Is gold part of the everything asset bubble that we're seeing? Is it part of the overall global melt-up that we're witnessing, or is it a completely different asset class behaving and playing by its own rules? Really want to hear from you down below. Also, maybe you could explain to me, why is the GDX, or sorry, not the GDX, the S&P 500 running from all-time high to all-time high, completely shrugging everything off? Ted gave us his opinion, which I much appreciate. It's back in, it feels like we're partying like it's 1999. So let's see how much longer that music keeps playing. So thanks so much for tuning in. Don't forget to hit that like and subscribe button. We much appreciate it, and we'll be back with lots more. Take care out there.